This is a lecture from Open Tuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Chapter 4 deals with the subjects of ethics and corporate governance. First, ethics. And this is a branch of philosophy which deals with being able to identify what is right and what is wrong, distinguishing between good and evil. And once you can distinguish between what's good and evil, then your actions can be guided by these ethical principles. We'll see later why ethics has become very important in the world of business and indeed in wider organizational life. But first we have to look at a number of, I suppose, technical pieces of terminology. These are to do really with your approach to ethics. And the first one that we've got here is absolutists. And absolutists believe that there is a definitive difference between what is right and what is wrong, that something is always wrong. It doesn't matter what background you're from or what your beliefs might happen to be, you take the view that this action is always wrong. And similarly, I suppose you might take the belief that certain actions are always right. For example, most people in most cultures of the world will believe that theft is wrong. However, it might be possible to conceive in some cultures from some viewpoints that there are situations where theft is correct. And of course we see that there are disparities and differences in these outlooks when it comes to, say, the death penalty as a punishment. Some countries say it is always wrong for the state to kill. Other countries support the death penalty, for example, as retribution to a murder. So what we're getting away from there, or beginning to recognize, is it can be quite difficult to be absolutist because you will come across in many cases people who take a different point of view, and we have to work out our kind of relationship with these people. And in many situations we come down to a relativist stance or a pluralist stance, where you believe that nothing is objectively right or wrong, that right or wrong depend on your prevailing view of yourself or your culture, historical period, because of course that changes, or perhaps your religion. And we have to some extent an uneasy truce, maybe in some situations, between the absolutists and the relativists. So those are, if you like, high-level stances here, but what guidance can we get then perhaps as to whether a novel act, whether a new act is right or wrong? And the first one we have here is consequentialism. Whether something is right or wrong depends on the outcome of the act. So in some situations, this would say it would be justified in killing someone if in killing someone you prevented that person maybe from killing 10 people. And this consequentialism, it's saying the act itself has become right because the consequences, perhaps if you're not following it through, would have been so awful that justifies the act. Utilitarianism is a branch of consequentialism which states that the ethically right choice really depends on the greatest good for the greatest number, or the least unhappiness for the greatest number of people is what you want to avoid. Now this may seem superficially attractive. What could be wrong with doing actions which bring the most survival or happiness or satisfaction to the most people? But it's easy to puncture that one. For example, let's say there are 10 people who need transplants of various sorts. So 2 of them need kidneys, 2 need eyes, 1 needs a heart, 1 needs lungs, 1 needs pancreatic, whatever the list of possible transplants is going to be. And we have standing before you a healthy individual And is it right, and these people, let's say, are going to die, they don't get these transplants, would it be correct to, in a way, sacrifice and cannibalize this healthy individual, giving one kidney to one person, another to another, etc., all the way around? After all, you've killed one to save 10. Is this not simply what utilitarianism is saying? The greatest good is being done for the greatest number of people. Tough, obviously, if you're the deceased healthy one. And none of us, I don't think, would ever say that's going to be quite the end of the story. And so utilitarianism may be a guide in some circumstances, but it's not necessarily going to be the definitive answer. And then we have a kind of fairly tactical word here, deontological. This is a duty-based approach to ethics, which is concerned with what you should do and not the consequences of your action. So here it could take the view that murder or killing someone is always wrong. That is, it's your duty not to kill people, even if killing that person could have prevented a lot of other evil happening. So you're aware of somebody plotting, maybe to kill members of a rival family, but instead of killing them before they get to the rival family, you kind of let it go through, saying that this duty, this moral imperative, if you like, overrules all consequentialism, all utilitarianism. Really just need to know what these different terms are. Any moral dilemma you'll be given at this level is going to be pretty straightforward. Now, why are ethics important to business? And of course, different stakeholders, those are people, if you remember, with different interests in the business, are likely to have different ethical views. It could be that the directors, managers find it ethical to insist that people work very long overtime, come in Saturdays and Sundays, maybe destroying their family life, whereas other individuals within the organization might regard that as being unethical. Or sometimes managers might say, we'll get this work done cheaply if we have it done in a country where child labour is common and is legal. And of course the shareholders may be revulsed by the use of child labour. What I think has to be important is that the company and its ethical stance has to be open. Where things get very difficult, if there's some element of a cover-up somewhere, and this is liable to do great damage to companies and other organisations. The company must be plain in what its ethical stances are, and then you can either avoid that company, become on-stakeholder yourself, so to speak, or maybe you can bring influence on the company, but we don't really want secretive stuff going on. And there are very good reasons for this, as we'll see in a moment. How do people know what is ethical? How does a new employee know what is allowed within a company, say for accepting entertainment from a client or entertainment from a supplier as a potential reward, maybe for placing a large order with them. And this can be made easier and plainer if the company issues what's called an ethical guide or a corporate code of ethics, so that you set out as best you can what is allowed, what is not allowed, ideally giving some little examples of behaviour that would be tolerated and behaviour that wouldn't be tolerated. And it will require maybe quite an educational process in newcomers to the company to absorb what the ethical stance of the company is. Now, why is it important? Well, you don't have to even appeal to notions of what is good and what is bad. You don't have to appeal and actually say ethics are good or good behaviour is desirable for its own sake, is a kind of reward in itself, because of course different people might have different views on what what good behavior is. You can justify ethical behavior very much in terms of the profit and loss of a company. That good ethics will make companies more profitable. And the reason that is so is that most companies which are unethical are eventually found out. Either journalists find them out, or perhaps there's whistleblowers within a company, or a government inspection brings it to light, or there's an accident within the company which shows that they've been very bad at health and safety matters and unethical on that and so on. And when a company is found out, then really there is hell to pay. Investors and regulators and governments, even employees, really dislike it when a company is found out to be unethical, and really punish it. And there have been examples of that very recently. For example, Volkswagen. Volkswagen, not so long ago, was a very highly regarded car company, highly regarded for its no-nonsense engineering and the quality of its cars. And then it was discovered, of course, that it was telling lies and making up figures in its emissions figures, both in Europe and the States and probably somewhere else. And the share price of Volkswagen really plummeted, 25% of it. Volkswagen has opened itself up to huge fines from governments, from huge costs to compensate owners for being duped into buying cars which are better performance than that was actually being reported. There are also examples of pharmaceutical companies. Pharmaceutical companies discovered, for example, that a drug had an unfortunate side effect, let's say increasing somebody's chance of a heart attack. And what they did was to suppress that evidence, and they would be marketing the painkiller, for example, without any warnings that this might be bad for people with weak hearts. And when they were found out, again, there was the world to pay for this, because you can imagine the loss of trust, the damages that have to be paid, and the regulatory input, the loss of goodwill and so on that would come from that. So therefore, good ethics simply reduces the risk for shareholders. There's nothing nasty being hidden in the cupboard. And if there's nothing nasty being hidden in the cupboard, there's no bad news waiting to bounce out that you haven't heard about. Now, obviously, if you're in the pharmaceutical business, you know there is a chance that after 5 years of a drug being used, an unwanted side effect becomes obvious. But this is part of the risk of investing in the drug industry. In a way, nobody minds that. That is factored into the returns. What we're talking about here is misleading people, covering up evidence which would perhaps hurt the product and which is then later discovered. So it reduces the risk for shareholders. You will learn at some point that the return required by shareholders and lenders is linked to the risk. The higher the risk that you're putting your money to, then the higher the return you want that money to earn. If it's a low-risk company, you are happier with a low-risk return. And indeed, the lowest risk of all is probably putting your money in the bank, where you get interest. You don't get very much interest, but most banks are not going to go bust, and many are protected by the government and so on. So lower risk, a good track record of being a reliable low-risk company will enable you to raise capital and loans at a much lower rate. People will like you. Goodwill, trust, and so on will grow. The people will automatically go to a company that they trust. When a company launches a new product, people have trust in the new product because nothing nasty has come out on what the company has tried to do previously. Regulatory compliance is easier to achieve. It is to reduce, and it will reduce the cost of damages and fines, and indeed of proving you're complying with the rules and regulations, the inspections and so on. If you're found to be untrustworthy, for example, in health and safety, you can be sure that the health and safety inspectors will be coming around regularly. But if you have a really good kind of ethical reputation in health and safety, then you'll have fewer inspections and lower costs, and of course many fewer fines. When it comes to recruitment, good people want to go to good companies. You'll find it easier to attract the better people. And similarly, if you want to enter into a joint venture, an alliance with another company, why would you volunteer to form an alliance with a company which has got a dodgy background, which is untrustworthy, which has proven itself maybe several times to tell lies to its customers, lies to its investors, or lies to its government? So good ethics in the long term will improve shareholder value and will improve the lot of all the stakeholders. Sneaking on ethics, being bad on ethics, is liable only to give you a cost saving or an advantage which is terribly short run, and the disadvantages later will far, far outweigh that. Now, CIMA and all firms and all bodies of accountants are very keen that the members and their students adhere to ethical guidelines. To a large extent, an accountant being ethical is what you might call an ultimate selling proposition. It helps you earn more money, basically. It's part of your value. Why would people pay you a lot of money to give a report if they didn't believe you were willing to give that report fairly and impartially? If they believed that you would cover up, if they believed that you exaggerate, if they believed that you would lie in a report of some sort, why would they pay you, or why would your profession attract a lot of money? So being ethical is very important. And it's worthwhile maybe here saying the distinction between a professional body like CIMA or ACCA or Institutes of Chartered Accountants, the difference between getting a qualification there and getting, say, an MBA. Well, if you get an MBA, you're awarded your degree, really you have that degree forever. It's kind of a lifetime. But if you're in a professional body, the professional body can throw you out. The professional body can throw you out at any time for unprofessional conduct. For example, if you acted unethically. The professional body also insists that you keep up to date. So whereas you may have got your MBA 25 years ago and have never read anything technical since, you still have your MBA, for most professional bodies, if you want to keep your qualification, you have to prove and undergo annual continuing professional development or professional education to keep your qualification up to date. You must know what the ethical principles are. These are issued essentially by the International Federation of Accountants, an international body which tries to raise the profile and the standing of all bodies of accountants. And in particular, there's a subsection of IFAC, the International Ethical Standards Boards for Accountants, ISBA, which is particularly responsible for ethical matters. And the guide has 5 fundamental ethical principles. First, integrity. Now, many people think integrity and honesty are the same thing. Certainly honesty is part of integrity, but integrity goes a little bit further. Integrity means standing up for what you believe. Integrity means not giving way, certainly without very good argument or persuasive argument. You stand up by your beliefs, say, no, that is wrong, no, that is the wrong figure to put in the cash flow because it's just a made-up figure that you need to impress the bank and so on. It also means that if you see something wrong, you don't turn a blind eye, that you pursue matters, you're not frightened to look. You need all of this: honesty, standing up for your beliefs, a courage to follow up where you have doubts and worries about maybe the behavior of a company. Secondly, there is objectivity. If you're asked to give a report, let's say you're asked to prepare a profit forecast, you must be really, as best you can, using objective evidence to decide maybe what next year's sales are going to be. You mustn't be weighed, say, by the managing director coming in and saying, could you increase these sales by 50% because we need that, and so on. And then, of course, what happens with these principles, the framework really is you have got the principles and you identify threats to those principles. And what you need to do is to try to set up safeguards to eliminate or to reduce these threats way down. So in objectivity, for example, this could be threatened by self-interest. So you own shares in a company, you work for that company, you're asked to produce next year's budget for that company, you know the share price is going to be influenced maybe by the budgets, and simply by owning shares in the company, wanting to increase your personal wealth, that's self-interest, you could be pushed into being non-objective and giving a very flattering budget. Or it could be that you're asked to do some work for a friend, and the friend needs a loan from the bank, or the friend needs you to sign some report saying that the friend has complied with certain rules and regulations. You value your friendship, you don't want your friendship to be lost. And again, this familiarity, as it's called, comes in and puts a bit of pressure on you applying these principles of integrity and objectivity. You are being affected by other influences. So what you need to do is to think, well, if I'm going to be possibly affected by my friend putting influence on me, maybe I shouldn't do work for my friend. Maybe I should say I'm not really the right person to do that, or I feel uncomfortable about doing that, and so on, and ask that your friend goes and gets an independent accountant to do that bit of work. Remember, this eats away at almost the saleability of accountants. If we all began producing reports which are what our bosses wanted, or what your friends want, or what other stakeholders may want, rather than reports which is as near as we can get it to the truth, we are undermining our value. Professional competence and due care, you have to keep up to date. That's part of professional competence. You have to spend enough time in something. You have to be intellectually able to do it. You have to be sufficiently specialist and knowledgeable about the area in which you are being asked to apply expertise. So if I was asked to prepare somebody's tax return, I shouldn't. I may have studied tax, but I may have studied it 25 years ago, and for me to set out and say I can do your tax would be not showing professional competence in due care. Confidentiality. Accountants are in very privileged positions. We see typically everyone's wages. We see what next year's budget's going to be. We see the 11 months results, and only another month to go maybe before these results are made public. If we see the 11-month results, we tell our brother the results of this company is very good, and your brother goes out and buys some shares in that company, then apart from being criminal in many jurisdictions, you are not exercising this principle of confidentiality. People must trust you, believe that you're not going to tell other people confidential matters. The exceptions to this are obviously if the employer or the person you're working for, their client, allows you to divulge information. So if you were preparing a cash flow for the bank, obviously the client is going to allow you to show that to the bank. If you have a professional duty or a legal duty. So in the UK, if you suspect someone of money laundering, there is a statutory duty to tell the authorities that you suspect money laundering. And sometimes you have a right to disclose information. So if a client was, or someone was suing you maybe for negligence, you're allowed to defend yourself in a court of law, even if that maybe means bringing up some matters which would normally be normally regarded as being confidential. And finally, there is professional behaviour. You have to comply with laws and regulations of the profession, of the company, of the country, and you mustn't bring the profession into disrepute. For example, if you're advertising, you mustn't say, use us because that firm of accountants are rubbish. You're not allowed to kind of push down the accountancy profession. So, as I say, compliance with ethical guidelines is continually threatened. We have these threats, and what we have to do is to reduce these threats down to acceptable levels, which may mean avoiding the work entirely, or it may mean making the threat trivial. So, going back to these, objectivity here, you're working for someone, and they say, if you do this, then we'll take you out for a nice meal. Now, is the promise of a nice meal, is that a threat, or is that an offer you're likely to respond to or not? And it maybe depends on how nice the meal is. So if the promise of the meal is going down to the local McDonald's, probably relatively few of us will sell our souls for a Big Mac. But if the nice meal was going to a 3-star restaurant, then we might be tempted. And if the 3-star restaurant happened to be in the south of France and you had to stay for a week at your client's request, then obviously the threat has grown from something relatively trivial up to something which is very substantial and which would be very hard to justify. So there's a lot of judgment in this. And what's important is that the accountant is seen to be ethical. Not just that they are ethical, but they have to be seen by the public to be ethical. Often allied with ethics is the idea of corporate social responsibility. And corporate social responsibility puts forward the idea that companies or organizations are not just profit-making machines, they are part of society, and therefore they should fulfill more towards society than simply making profit. They should become good corporate citizens. Now, many laws, for example, will govern, as we have here, the release of pollution and greenhouse gases here. Many laws will ensure that there's health and safety and pensions and sick pay and so on there. Obviously, you pay tax. That can be redistributed to whatever the government thinks about here. But corporate social responsibility means really going further than is required by the law. That you have maybe an aim to have zero emissions or 100% recyclable waste and so on there. That you go much further in offering sick pay and training and opportunities for employees. That you make large donations, perhaps voluntarily, towards local charities. And some people say that companies should do this. And they say this, the main advantages, perhaps, of doing this are going to be reputational. Once you begin being a good citizen, if you like, at doing good works, and of course you can publicise this. And it can become part of your advertising campaigns, really. It can be done very subtly. It doesn't have to be an advertising campaign, but a good mention in the press about maybe a donation to a local hospital. It'll strengthen your brand. People love and trust the brand a little bit more. It can help to attract people. People are attracted as customers, as employees, perhaps as collaborators towards a company which seems to be well-meaning, if you like. And of course, there can be real payoffs here if you do reduce your carbon footprint, if you do increase your recycling and so on. If you do maybe offer better welfare to your employees, you might actually make money out of it. It might actually save money somewhere else. Now, it has to be said that there is controversy over this. There's controversy over to what extent it is the duty of a company to try and do all of these good works. Companies have a legal duty to act in the interest of their shareholders and really to maximize the wealth of their shareholders. You could argue that giving a small donation to a local hospital will repay itself many times in terms of goodwill. But obviously, if you began giving away the total profits of the company to charities, then your shareholders are likely to get a bit aggrieved. And it may even not be legal to do that. And there are problems. What is the democratic mechanism which decides who benefits from these giveaways by companies, who's actually made the decisions to be doing that? And to some extent, if you spend money on some of these social activities, you're reducing your tax, which is reducing the amount the government gets, and therefore it can't spend as much on hospitals, schools and so on as maybe otherwise it could. Some people do say that the best thing a company can do is to be ethical and to make profits. And making profits will give secure employment, will enable the company to develop better products, will give better corporation tax inputs to the government, and then the government can spend the corporation tax according to the promises that it was elected on, and perhaps that's the best way to do it. But many companies are certainly trumpeting an amount of corporate social responsibility, but quite how much money they spend on that, it's usually quite modest, and probably should be quite modest for the reasons I've said. Corporate governance. Corporate governance, as it says here, is the way in which companies are directed and controlled. Now, a little bit of history here. 50 years ago, the way companies were directed and controlled, the members of the company elect directors. We're talking about large companies here, particularly listed companies, listed on a stock exchange. The members, the shareholders, elect directors, and then the directors really left to get on with it. Every year, the directors had to publish a set of financial statements. The financial statements were audited, and then they were distributed to the members. And that was the only way, really, that the members could keep an eye on what the directors were doing and how their company, how their investment was actually performing. Then in really the 1990s and the 2000s, there were a number of absolutely astonishing corporate scandals. Big names that you may have come across was Enron, there's WorldCom. Later, some of the banks and so on got into big trouble. And these companies were listed companies and so on. They had large firms of international auditors looking after them. And these companies, went bust, often within a few months of the audit. Maybe the auditors were at fault, maybe not. But people began to think, if you have your financial statements put out one year, waiting another year, and sometimes you could wait maybe 15 months before you got another set of financial statements, that's a heck of a lot of time for the directors to be kind of doing almost what they want without there being any supervision. And by and large, investigations into why these companies went bust, came to the conclusion that directors had too much power, and in particular, the chief executive officer often had too much power. And really there ought to be, on an ongoing basis, some sort of watching, some sort of a control, if you like, over what the directors should be doing. And this led to the issuing of various corporate governance code. This should say at the top here, the UK Corporate Governance Code. The word code should be in there. In the United States of America, they passed an act of law, the Sarbanes-Oxley Act, which is a very detailed, quite arduous act to actually comply with. In the UK and in a lot of Europe, in the UK it's a UK Corporate Governance Code. This is not part of statute, but any company which is listed on the stock exchange, the stock exchange rules mean that the company has to follow these rules, this code, or explain why not. And typical of what this code is saying are as follows. First of all, it says that the role of the Chief Executive Officer and the Chairman should be split. What was happening in companies like Enron is you had a very charismatic, almost dictatorial Chief Executive Officer who was also the Chairman that everyone was frightened to say no to. And really the board of directors would just kind of rubber stamp what this person wanted. And this allowed this person to take all sorts of outrageous risks and gambles and so on without the proper consideration. Here at least we have at the top the roles split. The Chief Executive Officer looks after the day-to-day running of the company. The Chairman runs the board meetings, looks after the agendas and so on, makes sure that there's proper discussion at the board meetings. Boards should appoint what are called non-executive directors, or NEDs. NEDs are full board members. They can vote at board meetings, but they don't have any executive responsibility, so they don't have any day-to-day responsibility in running the company. They are there to bring advice and to warn the board, and maybe to question the rest of the board on what it's doing. And it's not just one or two token non-executive directors. The Corporate Governance Code says that there has to be a balance. And this means really that at least half of the board have to be non-executive directors. These people's fees are not related to profits. Again, one of the problems with your executive directors is that they engineered themselves remuneration packages which encourage them to take risks. They will get a large bonus if the company doubled profit, but they get still quite a nice bonus if the company's profits halved. It was kind of heads I win, tails you lose. So the structure of the bonuses would encourage the directors to take risks, because really there's nothing to lose from taking these risks. Here, the non-executive directors are on a fixed fee. It doesn't matter what the results of the company is, these people get the same. So they should be much more objective when deciding what is going to be good for the company. There are three important subcommittees from the non-executive directors. The Remuneration Committee determines executives' remuneration. Again, this is going to be non-executive directors. And again, one of the big abuses of the old system was directors were basically setting their own fees, and because many shareholders didn't take a very active part, these were kind of just waved through. Secondly, the non-executive directors have a nomination committee. This is responsible for finding and appointing, or recommending the appointment of new directors. Again, the old problem was when it came to replace a director, the remaining directors would often maybe appoint a friend or a crony. And of course then that favour was returned later on. The way directors should be appointed is exactly the same as the way any other employee should be appointed. You should advertise, You should look at the CVs, you should do a shortlist, you should do interviews, you should appoint the best person, not the friend of the CEO. And finally, there's an audit committee responsible for liaising with both internal and external audit. This now, in a way, gives the internal and external auditors almost a direct seat on the board. It used to be these people would tend to liaise with the finance director, but think the finance director is the person who's kind of responsible maybe for the internal control, or responsible for making sure frauds don't happen. The auditors then discover a fraud. It's very embarrassing for the finance director. So the finance director mightn't have brought that up at the board meeting. Now, findings of the auditors are reported to non-executive directors. There is no embarrassment attaching to them bringing up these problems at the board meeting where they can be fully discussed. The board as a whole is responsible for decisions. Now, this you might think is odd. Surely the board was always responsible for decisions. But what happened with these powerful, charismatic, bullying, non-executive chief executive officers that we talked about is they would divide and rule. They would go to one board member and say, have a little chat and get them on board. And then quite separately go to another director's office, have a little chat. So it'd be really nice if you could do that and so on. And by the time the board meeting was held, all of the directors had been got at already and they'd kind of just rubber stamp it. Now things have to have a full and frank discussion at the board, and the board as a whole have to be presented with arguments and have to decide what to do. Also, they have to look at the long-term decisions of the organisation. It is a requirement of the ethical code that the board looks at the long-term future of the organisation, that it is not just worried about the profits that are going to be coming out when the year ends in 3 months' time. They are saying, how is this company going to be surviving in 5 years' time? How are we going to be reacting to the technological and market changes which are going to be taking place? And finally in this, it is the board who is responsible for internal control. Basically, internal control is what controls the operations of the organisation, the expenditure of money, the control of its assets and so on. How do we protect the assets? How do we make sure that money isn't spent in the wrong places? How do we make sure that overtime isn't being paid when people aren't doing it? How do we make sure that we don't pay suppliers twice? How do we make sure that we are indeed paid by our customers and so on? Internal control, in a way, produces the financial results and the records, and you can't possibly think that you are managing a company if the results and the reports which are being produced are wrong. And they will be wrong if there's not a good system of internal control.